You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. And on today's show, we're talking about life insurance policy loans during distribution, part of our competition series with Brandon Roberts from the Insurance Pro blog.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I am Steve Savant, your host, and we're broadcasting live to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today as my special guest, Day 5 with Brandon Roberts. Hey, Brandon.
Good to be here.
I got to tell you, all this week, if you missed any of the shows with Brandon, you should go back Monday's show, watch them in succession, www.brokersalliance.com, because we've been talking about competition items all this week. And we are going to hit the mother lode today with policy loans, talk about all over the board. Brandon, this is the universe, right? I mean, right now, when we're talking about distribution on IUL, par whole life, variable, current assumption UL, I mean, all of these are subject to the things we're talking about. Let's get right to it right away. We have so many people, illustrations are basically premised off current company practice.
Right.
All right. Now, I have policy loans. I have to find out, are my policy loans current company practice or are these contractually guaranteed? And surprisingly, there are a few carriers that actually do that. That whatever their current is, it is their contractual guarantee. Does that matter to a consumer?
It matters to the point that we need to be able to hammer on what is most likely to happen and what is absolutely guaranteed to happen. Taking the current assumption is not a terrible thing to do, but it's very prudent for you, the agent, to understand this is guaranteed or it's not guaranteed. Because if you sit down with a client and you show them an income distribution and you basically tell them, yeah, we'll get here, and it turns out that your assumed rate's too high and your loan interest rate is nowhere near its guaranteed rate, you run the risk of getting to a point where it's time to do what it was really supposed to do and you don't even come close.
Well, and I'm looking at the difference between current company practice and contractual guarantee. I also have to start looking at issues like this is a variable loan tied to some bond index, or it could be some kind of a fixed loan. Again, is it variable or fixed, and is it guaranteed or not? Now, just as a little side note, and I don't want to really get into telling about all the carriers involved in this because they didn't pay for the show, but my premise here is I have a couple contracts. There are two schools of thought, and one of those schools of thought is you should use withdrawals to basis, policy loans to gain, and those policy loans, if I can find it out there, I want to get zero net cost loans. And if it's contractually guaranteed, all the better. And we have a couple carriers that play in this realm. So if you say, because we're going to get into arbitrage loans here in the second half, we get into arbitrage loans, people say, I'm just uncomfortable with that kind of thinking and that kind of statistics. I don't know if that's really going to happen. But I'd rather do the purest way, a little more calmer, everybody can understand it, and get the guarantees. You may want to go down that road and you say, Steve, who are these guys? Just call me, 1-800-290-7226, or write me thebiz@brokersalliance.com and I'll send it to you. But when we're talking about variable, I'm bothered some of this because some of these variable contracts don't have enough lower ceiling on their caps. I mean, I could get in trouble here.
We've heard some agents and some companies that have kind of led the parade against IUL and UL talk about the moving parts. And it's not that complicated, but we do need to take care of the moving parts when they exist. And so understanding the contract is step one, and then step two is just making sure that you're really recommending something that's going to keep as much of what you think is going to happen in play.
So if I'm looking at, let's say I'm just looking at the top 5 carriers that actually deliver income, and believe you me, we look through this all the time. I check it about every 60 days. I go back into the system and I ask for reruns on all our proposals that show maximum income, and I look at it at the withdrawals to basis policy loans and arbitrage loans or participating loans. Then I mark to mark those that are fixed and those that are variable to see what would happen if I had to go to the contractual guarantees. I always want to make sure about this. And now this is the thing I'm talking about, Brandon. It's like I see these loans today, and loan rates are so low. I mean, they are. And so everybody says, wow, whatever we're talking about. By the way, think about this. Consumers, when you say your loan might be costing you 2 to 3%, he goes, oh, that doesn't sound so bad. Right. But it really has terrible impact on income distributions. I mean, 300 basis points could be a huge swing. When you're talking about your retirement money.
Well, we used to see the investment world talk about what you could take out each year. And it turns out that everybody who said, hey, yeah, 5% is probably fine. In fact, there's some very big names who got behind that number, who have recently decided, yeah, we didn't do that right, so you need to do much less than that. We're running into a similar situation. If interest rates on loans are bouncing around, and we run into the possibility that what we assumed was very incorrect, and it doesn't have to be a bunch of basis points, it doesn't take very much over time to compound and really make a problem. And so we have to stop and not turn ourselves into the mutual fund industry where we're retracting and saying, no, that was a mistake.
And think about this is a huge point you just brought up. A lot of people are punching 4% now. They're down to 4% income. But I remember only a decade ago, these were calling for 7 and 8% out of your qualified plan. It wasn't going to last then. It's certainly not going to last now, and especially in the light of the mortality revolution when everybody's living so much longer. When we're talking about these ideas, I need to know about the cap on the variable, because I kind of want to use it, but then I feel like if I don't have enough, if they don't cap it off and I'm at a 9%, they could charge, I could get killed.
And you can find all that information. I mean, it's widely available. You just have to take the time to look at it, and then you have to take the time to sit down with the client and say, yeah, that shows that, but here's where the guarantees lie on this side. And if we adjust it to make it more realistic, and we can get illustrations, and you can always go out and find the information you need, you can make the comparison.
Well, we can compare that all for you. Again, you can just write me, thebiz@brokersalliance.com, and I'll show you these kind of comparisons. When we come back from the break, we're going to talk a lot more about arbitrage loans and a little bit about phantom income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Companies in our business are always touting service, products, and underwriting. And we do that too. But here's the difference. Now enter the world of the elite producer with a value package that cuts us out of the pack. A BD that approves social media marketing of non-FINRA products and doesn't take an override. With the best competition desk in the industry, and for our loyal producers, a true group health plan. No one offers that. Brokers Alliance does.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant. We're with Brandon Roberts, one of the largest bloggers and writers on life insurance product. His expertise is second to none, and he's part of the next generation coming up from the young people to this generation. I so appreciate it because every time I go to a convention, everybody's my age, So it's great to see young people coming in. Of course, you guys have seen, I've had Cheryl Moore on the show, Bobby Samuelson. All these people are under 40, and they're little geniuses. And thinking about Cheryl, a lot of the intel we get on these very things we talked about in the first segment, I go out to lifespecs.com. Cheryl, you owe me a dinner. And I really push it because everything's there. You're not going to read the sample contract. You're not even going to read the policy that you're probably delivering to the client. So this is the closest thing to it, a digest, a summary of the policy provisions. And I'm a very big guy on this issue. I want to know what the numbers are. And when we were talking the first half, we talked about current company practice and talked about contractual guarantees. Variable loan interest rates, fixed loan interest rates, and everybody telling me, hey, it's passe, nobody uses withdrawals to basis on arbitrage loans. Well, let me tell you something. If you had a contract in 2001, 2, 3, and 2008, during that 10-year period, and you took income at the beginning of 2001, you had 4 out of the last 10 years where you actually didn't get anything credited, and so your best scenario, maybe you had a fixed rate of 4 or 5%, you are paying 400 basis points for your loan and the expense charges of the policy in the same year, 3 straight years in a row. I mean, that's a heads up, wake up.
It's going to hurt income.
That's going to hurt income. And by the way, when I did the test, It's bad when you have this happen at the end of your client's life and distribution. I just showed you what happened if you were starting to take income in 2001. The first 3 years were punitive. They just killed the contract. Whatever numbers, he said, Steve, how bad was it? I tell you what, the one I looked at had a $52,000 projection. After the end of the 3rd year, it was $38,000. See, I mean, it hits heavy at the early times of distribution. Absolutely. So it matters. If I run into a thing like that, I'm going to duck out of arbitrage loans for sure and use withdrawals to basis, which we've forgotten how to use. I mean, how did that happen?
Some of us still live in the world of current assumption UL and whole life, so we haven't forgotten it completely.
Oh,
but
God,
yeah.
Well, I'm bothered because I noticed that we see everybody. I never see withdrawals to basis anymore. And I said, believe you me, in the bad boy years, and you're only going to get maybe 4 or 5, maybe 6 at the max, depends on how you modify your distribution. But you're going to need withdrawals to basis for those years which you get no crediting. Otherwise, you're going to be paying through the nose on policy expenses and the policy loan provision. I'm just trying to tell you now. And when you ask me in my design, I'll always tell you, hey, just remember, here's my caveat, withdrawals to basis. This could be something. Now,
but it's not the absolute solution.
It's not the absolute solution, right? I mean, it's just a mitigating solution. I mean, my absolute solution is, if you don't believe anything of arbitrage or participating loans, go to zero net cost loans with the companies that give it. And they're out there. Right. I have a huge teaser here, and when you hear this, everybody's going to be hitting my phone. It's bad enough that I usually show income from age 65 to LE, your life expectancy, or income from 65 all the way out to age 100. But now I have a couple carriers that actually will go ahead and whatever my distribution method is, and the one I just looked at the other year, or 2 days ago, it was showing me $54,000 of income, and I said, and then of course at age 100, it'll just keep the death benefit online so that it won't be a taxable event, and that'll be it. But no, the premium kept going past that. So I said, how can that be? I must have done the illustration wrong, but not I, Mr. Connoisseur of all that is proposal, right? I went back and I called the company and I said, hey, what's going on here? I stopped the payment on your illustration at age 100, but the actual distribution kept going all the way out to 120. He goes, we guarantee that even though you put age 100, the distribution goes all the way out past age 100. Now, have you seen this?
When you told me about it, it was news to me.
I'm in shock. And by the way, the carrier, we called him this morning just before we went on the air. I called him, I said, and what is the event, taxable event? Because I cannot believe everything after I've bled through all the gain in the policy, I've taken all my withdrawals to basis, all that has occurred, and you're still paying me past 100, that has to be a taxable event.
Right.
And of course they concurred with that. But have you ever heard of this until I just told you this? I mean, this is wild.
Not a word, and it's a fascinating feature. It's going to be interesting to see how they support this benefit. On the taxable side, it should come as no mystery, I don't think, to anybody that it's taxable. You've burnt through all the money that you had. They're giving you something. It's earned income at that point.
I'm really interested in this because we ran into some of this similarity about VA income, right? And when was it going to be taxable, non-taxable? A lot of issues like this. Now we're dealing with it in IUL because we didn't think the numbers were going to go out this long. And so now we're looking at people who say, wow, I have a great income. It goes all the way up to 100. All that's tax-free if it's done right. But now anything beyond age 100, oh my goodness, where are they getting the money to pay me the same premium, the same distribution? I love it. It is taxable though. Lastly, I want to talk about one thing that's really important. Now, we talked about this on the show early on about the maturity dates and so forth. This really matters. Maturity dates. And what happens if I mature, I actually live to the maturity date, and I have all these loans online?
Policy matures, you get some cash if it's there, but everything that's outstanding in a loan is now taxable.
Now think about that. Everything that's outstanding in the loan, not only the policy loans that you've already taken constructive receipt on, but all the loans that are inside the policy, because I don't know anybody that was paying the annual interest all along. This is what we're talking about, right, Brandon? I mean, these are the things that we struggle with all the time, trying to get our producers, our agents, and our advisors to look at these issues, because these are the issues that are going to either make us just heroes for bringing it up, or it's going to cause a lot more angst inside the marketplace, and of course that's our goal.
I say it all the time. You can be the product guy. You can sell any of the other products for the most part. What you need to be is the expert, and that's where people will gravitate to you. And when we compare policies, I can sell that one, I can sell this one. It's really, am I the most knowledgeable guy in the room?
That's why I have the expert. That's the Buzz on the Biz. See you next week.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.